So welcome everybody. Welcome to the InnovaCorp Investment Readiness Series presented by Startup Yard at Cove. My name is Shelley Hession. I'm the manager of Startup Yard, which is an InnovaCorp incubator focused on ocean technology startups. Today is part 2 of a 4-part series, and the title of today's session is Developing Your Funding Path. Our presenters today are Ben McDade of InnovaCorp and Sarah Kohlberg, a communications and strategy expert. Andrew Gennon, who was previously scheduled to present, sends his regrets. So before I do introductions, I'll invite Jennifer Fatullo of InnovaCorp to say a few words about the upcoming sessions.
Thanks, Shelley. Hi, everyone. I'm Jennifer. I'm an analyst on the investment team at InnovaCorp. First, it's just fantastic seeing everyone here today and to have so many exciting ocean tech startups in attendance. As Shelley said, this is the second of 4 sessions in our investment readiness series. The following 2 sessions will be held over the next 2 weeks, same day, same time. So Wednesdays at 1 p.m. Atlantic Standard Time. The next session, which is next week on December 8th, is The Art of the Pitch, which will now be taught by Andrew Ray, who's our VP of Investment at InnovaCorp. And our 4th and final session will be on December 15th and is on Closing the Deal, which will be taught by John Sari, an investment director at InnovaCorp. Many of you are already signed up to attend these sessions, but if anyone is not yet signed up and would like to attend, please just shoot me a quick email. You can find my email in the reminder sent out for today's session or on the final slides of the presentations today. That's it for me for now. Again, welcome, and I'll pass it back to Shelley.
Perfect. Thank you, Jennifer. Also, a big shout out to Jennifer, who actually planned and organized this entire series. Thank you so much, Jennifer. A few housekeeping items. So please stay on mute when you're not speaking. If you have questions, you can put it in the chat or raise your hand. Ben is open to questions throughout the presentation. Jennifer and I will also monitor the chat, and we are recording the session. So let me introduce Ben. So Ben McDade is an investment associate with InnovaCorp. So in this role, Ben identifies prospective investments, conducts all aspects of the investment review, approval, and closing cycles, such as screening opportunities, analysis, due diligence, and making recommendations. So Ben is a valued member of the InnovaCorp team and has an expertise in enterprise software. So welcome, Ben. The floor is yours.
Hi, folks. Thank you, Shelley, Jen. Excited to walk through this session number 2. So let's get started. So happy to do this, of course, today with Sarah, who will be delivering the second half. In part 1, we'll discuss your financing paths, different sources of funding, and how much you may want to raise at each stage of your business. The latter half of this session, Sarah will cover how to boost your personal brand, building an online presence, as well as media continuity, and creating fear of missing out, or FOMO, as you pull together your investment round. So let's get started. Generally speaking, as an entrepreneur, you kind of have 2 paths. The first is bootstrapping. So when you're bootstrapping, you're relying on your personal savings, company revenue, as well as maybe personal credit lines to fund operations. You're not going to outside investors for financing, essentially. So with this path, there are definitely advantages and disadvantages, which we're going to walk through. So let's talk about some pros. So the first advantage to bootstrapping is that you're going to retain ownership. Relying on savings or going into lines of credit or debt products, you're not selling an equity stake, and therefore you have complete control of the cap table. And that leads me to the second benefit, which is you have full authority to steer the ship, to essentially run the company and make the decisions you need to, and the ones that you see are right at the time. Another benefit with bootstrapping and I guess not taking outside equity investment is that you control the exit timeline. This could be a potential sale, selling to a certain buyer that you may have in mind, and for the amount that is acceptable as an acceptable offer to you. So some disadvantages for bootstrapping is that generally speaking, you're going to have access to less capital. And with less capital, we all know things can take longer than expected and cost more. There's higher risk of insolvency. You may be subject to slower growth, less capital. You cannot maybe hire as fast or acquire the resources you need to develop and advance your innovation and bring it to market. And maybe even at the earliest stages, you're continuing to work a full-time role, and this is something you develop in the evenings while you transition to going full-time with your entrepreneurial venture. Another, call it disadvantage to bootstrapping is that you don't have access to an investor support network who has a vested interest in helping your company grow and overcoming hurdles. Another option is venture capital. So venture capital is essentially whereby institutional investors pool capital together into funds that are managed by often experienced founders and financiers known as general partners who scout out, game-changing technologies and teams with global market potential. And these venture capital funds seek to return a multiple of their invested capital, generally on 10-year horizons. So things that you should consider as you explore how you want to finance your business is whether or not your company is a fit for venture capitalists and would be interesting to them. So we'll go through a few items, and this will kind of just set context whether or not VC is right for you. So are you building a world-class team? Experts in your given field of technology or industry certainly help. Founders who have built teams before and grown companies to in excess of $10 million in annual revenue. Those are the types of companies that VCs are looking for, and doing so on relatively shorter horizons, 5 to 10 years. Does your product or solution solve a massive problem that can be quantified? That's another thing we look for. Is there a defined customer base that leads to a massive global market? That's another thing that excites venture capitalists. Is your solution defensible? Is there what we call a moat? Are there barriers to entry around, the innovation that you're bringing to market? IP strategy often plays a lot into this. The other thing we look for is that your product or solution is, or can be, or will be a no-brainer, an obvious choice for your customers. And in that, especially in enterprise ventures, B2B, being able to quantify the return on investment for your customers helps your sales process and is something that venture capitalists look for. We also look for scalable business models and an eventual path to profitability. So if your company exemplifies these traits, certainly consider raising from venture capitalists. So let's get into some funding sources. The first of which are debt instruments. So whether or not you bootstrap or you go with venture capitalists, usually it's a combination of debt and equity. We're all aware of credit cards, credit lines, personal loans and or business loans. And then there are other instruments such as debentures, which are unsecured loans, usually with a higher interest rate, and corporate bonds, which are secured. And because these loans are secured, they tend to have relatively lower interest rates. So lenders will assess their appetite for risk and your ability to, or your company's ability to repay those loans, and will determine whether or not the loan requires collateral and the amount of that collateral, and will ascribe an interest rate based on risk. So now let's look at equity securities. So you as founders most often have founding stock, which is often common shares. You may have different classes of these common shares, A, B, or C. When investors come into play, often at the institutional level, which is usually the seed round, they'll look for preferred shares, which have certain advantages over common shares. There are other equity securities such as warrants and options, which we won't go into today. And in the middle, we have hybrid instruments. So these are a blend of debt and a blend of equity, and often give a right to convert that invested amount into equity at either the discretion of the investor or during a triggering event. A KISS is a keep it simple security, commonly used in the last 5 years, as well as SAFEs, which are simple agreements for future equity. These are lighter forms of paperwork compared to share issuances for common and preferred. The benefit here is that the deals get done faster. The investors and the founders are typically not going back and forth on terms so much, but there are some key negotiating pieces, which I'll get into shortly. Another hybrid instrument is a convertible debenture, which is what we saw more of, 5 to 10 years ago, and we've seen an evolution towards the lighter paperwork, SAFE and KISS investments. Convertible debentures carry kind of a set maturity date, and usually an interest rate of 6 to 8%. So between debt and equity and hybrid instruments, there are different sources where you can go look for capital. The first we'll look at debt is the Business Development Bank of Canada. Of course, they're nationwide. They have presence here. The Atlantic Canada Opportunities Agency is very, very active within the ecosystem. I'm certain many of you have accessed their programming. Futurepreneur, if you have founding members under 40. Commercial banks, so the big 6 banks, some of which have lending practices for innovative technologies and teams, and credit unions. On the equity side, the Business Development Bank of Canada will invest nationwide through their equity funds. Innovacorp, of course, we manage an early stage venture capital fund, roughly 50 companies in our portfolio on IP heavy companies. Concrete Ventures, they are a local fund managed by Patrick Hankinson. They'll typically do pre-seed enterprise software. Nova Scotia and throughout Atlantic Canada as well. Build Ventures goes a little bit later. I think they're doing investments, well, certainly across Atlantic Canada, I think on Ontario as well. They're seed and beyond, so seed and Series A primarily. Of course, the angel investment community. We have a strong and growing community there. And a neat addition to the ecosystem in the last few years has been the St. Mary's University Venture Grade, which is a student-run investment fund investing under $30,000, so typically at the angel stage or before. Additional sources of capital are grants and tax credits. So Nova Scotia Business Inc., NSBI, very supportive for technology companies. ACOA again, the National Research Council's Industrial Research Assistance Program, SHRED, which is Scientific Research and Experimental Development for funding towards R&D, Innovative Solutions Canada, as well as other federal programs such as the DND's IDEAS and Sustainable Development Technologies Canada, funding towards commercializing or sustainable technologies. Excuse me. So a resource we're happy to share with you is the federal government's Business Benefit Finder. You will be receiving the slides after this presentation. So just click on this link. Some of you may have used this, but it's an excellent resource to provide, kind of a personalized list of support services based on the stage of your business and the industry. So let's look at debt financing, some of the advantages and disadvantages. So with debt, of course, there is no ownership dilution. You're not selling equity in return. You do retain full voting power, essentially, and authority to control the company. And the interest payments are tax deductible. So with debt, you're not only repaying the principal, of course, but the cost of that capital, which is the interest on that debt. For certain loans, your company may be subject to interest rate risk. So a rising interest rate means an increased liability for you to repay. And at the early stages, personal assets will often be used as collateral on certain loans. Of course, read the fine print, know what you're signing up for, and take calculated risks. So on the flip side with equity, an advantage is that there is no requirement to repay the investment. So essentially, if your company goes under, heaven forbid, there is no obligation to repay that investment dollars. Whereas, of course, with secured lenders, any assets that are able to be liquidated, there is an obligation to repay those lenders. With equity financing, our investors, they're looking to the long term to build wealth. It's not similar to debt in the sense that they're looking for a quicker return through interest payments. So equity financing is usually to fund projects or milestones that will increase the value of the company, and investors will get their returns through the sale of that equity, or in some cases, dividends. And a great benefit of raising through investors is equity partners are incented to help fuel growth, use as sounding board, and leverage their network to really help move things forward. There's a higher cost of capital with equity financing than debt financing, so therefore there is a share of the profits that you're giving up. Now, this is not necessarily it can be viewed as a disadvantage, but it's certainly a characteristic, is that you're selling a piece of the cap table, you're diluting your ownership as a founder when you're pursuing the equity financing route. And you're bringing new members to your team, either on the board or through voting shares, and therefore there is certain shared decision-making, which may or may not have a, it will add benefit in certain instances, but it may slow decision-making. So you're likely familiar or have heard of a simple agreement for future equity. I'm going to share a little bit about the SAFE instrument. So SAFE holders, so the SAFE investors are not shareholders. Essentially, they're investing, with the understanding that their investment is at risk, and that the promise is that the upside is that the invested sum may convert to shares, or it may not. Where there is upside, in certain instances where the SAFE investment may convert into stock. Usually this happens at a triggering event such as a qualified financing. Usually it's of a certain amount, often in preferred shares is what we see. So that invested sum will convert on the same terms as that future issuance at a defined price per share. The instances whereby a SAFE will not convert is that the company is able to get to, call it, cash flow break even and fund growth going forward, and the triggering event doesn't happen. That is a risk to the investor, the SAFE investor. In some cases, the SAFE investors may be able to convert into common stock at their discretion within a certain time period. Sometimes there's a maturity on SAFEs, sometimes there is not. And because SAFE holders or SAFE investors are coming in early, they want to be incented or at least a benefit. And the share price will be determined by a valuation cap and oftentimes as well as a discount. Discounts range from 10 to 20%, and the valuation cap will vary as well. But essentially, the SAFE holders are rewarded by coming essentially for investing early. Okay. So now we'll talk about how much to raise. And there's a lot going on in this diagram here, but I'll point your attention to the stage and the description. This is how InnovaCorp kind of views different opportunities as companies de-risk and grow. So at the idea stage, companies are identifying a problem, they're and kind of conceptualizing a solution around that problem. At the discovery stage, they're doing customer validation interviews, really understanding who their target market is, what motivates them, and what the cost of that pain is. At the accelerate stage, we're pairing that solution with the pain, and we're getting a better understanding of that addressable market, which will eventually translate into sales and marketing. The angel stage is where you're first raising some outside capital. Here you're building a minimum viable product to test your hypothesis that you've discovered in the earlier stages. Pre-seed rounds, you're often testing through a beta. Usually you have so a beta with a defined customer base. Beta can also be a pilot as well. And usually there is some inclination that there are favorable results or outcomes from your studies or pilot. Pre-seed rounds on the software side typically are in the range of $1 million. I'll get more into the investment sizes shortly. And at the seed stage, you're converting your pilot customers into commercial customers and learning more about your business model and all the processes that go into helping the company scale. Fast forward to the Series A is where really that growth capital comes in, and you're raising larger rounds and expanding geographically and maybe horizontally as well across different customer groups. So this is a lot going on in this slide here, but I'll point your attention to the bottom of the triangle here at the angel stage. So thinking back to the previous slide, at the angel stage, companies will typically raise between $250,000 to $500,000 at a valuation typically in the range of $1.5 to $2.5 million. Here I have 2 to 3. The rule of thumb is that as your company progresses, and usually these intervals are 18 to 24 months between stages, you're going to sell 15 to 20% of your company's total equity in the round. So the pre-seed stage, most often in this ecosystem, these are rounds where the dilutive portion is generally $500K to $1 million at round sizes in $3 to $5 million. Seed stage, typically most often $1 to $2 million, maybe a little more. Valuations of $5 to $10 million, and then the Series A, this is the growth capital. Usually $2+ million, even 3 to 5 is most common at valuations in excess of $10 to $1 million. There is, if you look at different ecosystems where there may be more capital, more innovation, and deeper pockets, there is a greater appetite and competition to get in the best opportunities. Those investors will pay a premium for the best opportunities, and therefore may ascribe higher valuations comparatively to smaller ecosystems. And just to share, any of the logos you see here, our team, Jennifer and Shelley, if you have questions about those logos are happy to share a little bit more about which funds you should maybe look into to raise. Another resource we're happy to share is the Liquid Grid. So this is it's an online portal. It's a map which includes 120 innovation hubs which support ocean technology entrepreneurs and businesses. And here's a screenshot. So it's, again, you can search by type. So on the left here, we have accelerators, competitions, incubators, and innovation centers. And you kind of have an easy to view representation of where these programs are run out of. And if you know a program, you can search. So highly encourage you to check out the Liquid Grid through the link when you receive it, or of course, just at any time. It's an excellent resource. So now I'll go into sharing some tips for raising capital. Generally speaking, you want to sell 15 to 20% of your company each round. Actually, I'm going to rewind a little bit here. You want to sell 15 to 20% of your company each round. That's most common. If you do not raise enough money, you kind of put your company at risk of having to raise a bridge round. So you run out of money, you're low on cash, and then you're saying, well, listen, we need another $500,000 to $1 million to hit our milestone. And that's the main aim of each of these rounds. It's to essentially raise enough capital, get the right resources in place to hit a milestone that will at least double the value of your company, often in 18 months' time. That's roughly what we see. When you're landing on the figure as to how much you want to raise, you want to add in a buffer, because generally speaking, you want to avoid having to raise a down round or raise a bridge round, which may result, depending on your traction, in a lowered valuation. So the trick is, know how much you need to raise, put a well-organized cash flow in place with a bit of a buffer that allows you to have essentially an additional 6 months of runway to get interest for your next round. So when prospecting for investors, if you are going to go the venture capital route, you want to look for investors that have a shared vision for the company and exit horizon. Most often, the lead investor will join the board of your company, and it's important that you guys really are on the same page. Of course, fair terms and aligned incentives. You're looking for trusted partners that may be with you on your journey over the next 10 years. So you really will want to look for fit. Of course, trust, competence, and responsiveness, it's a two-way street. So certainly, give yourself time, raise an appropriate amount of funds. Don't focus too much on dilution. Focus on bringing value to the table, and you'll do just fine. So here are a few more tips. Give yourself, as mentioned, you want to give yourself 6 months to raise your round. And you want to do all that's in your power to allow you and your team to focus on growth. And that's what investors are going to look for. So what founders find, as I'm sure many of you have, is when you start to raise money, it takes your focus away from operations. So some tips to free your time, or to be well prepared, of course, and in doing so, organize your diligence in a data room. That can essentially allow the investors, once they're digging in, and the team of analysts, to really assess the opportunity without taking too much of your time. Part of this is honing your pitch and rehearsing the presentation. So know your numbers, know the path to market. Andrew Ray will go into this, but be well prepared. Excuse me. one of the first things that we advise is to scout a lead investor who will then set your terms. It's often a chicken or the egg situation. Investors say, well, we're in it, they're in, and so on and so forth. Find a motivated buyer for your equity, a lead investor who can set terms and essentially is going to be viewed as a trusted, skilled lead investor from the outside. And being well prepared with your diligence and your pitch will help in those efforts. Of course, be transparent and as responsive as you can be. And communicate a target closing date. This shows that you're steering the ship. I wouldn't say put pressure on the investors, but you want to keep things moving. And, really you want to generate a sense that your round is competitive to get in. This equity is of value. There's a lot of upside here. And, we have to stick to a certain timeline if we want to, make this, capitalize on the opportunity at hand. Also encourage you to try to oversubscribe the round. Once you know how much you need, just like in sales, not all of your customers that are in your pipeline are going to convert. Same thing with investors. So aim to oversubscribe the round. If you do have more interest than, you're willing to, more interest than the capital that you're willing to sell for equity, you'll have bargaining power, right? You'll be able to negotiate terms that you wouldn't otherwise. Valuation may be one of them. And this is a thing that I highly encourage you to do, companies to do, is to share monthly updates with investors after they've closed. Not every investor is going to be on the board. They're not going to be privy to all the information that a board observer or board director would. But nonetheless, they want to know how the companies are doing. You as a founder, CEO, are being pulled in many different directions, but make this a priority. Have your shareholders send monthly updates. This is what's going well, this is what isn't, but be very specific and to the point. These are our 3 targets for the month. These are our targets for the quarter. Here's where we are. Here's the challenges. Investors love, well, I shouldn't say love to hear, but we want to hear when things aren't going right so we can get ahead of it and help you navigate a problem or find a potential solution. So certainly, encourage you to keep those relations strong with each of your investors. And when it comes time for you to raise more money, you'll find the new investors will want to speak with the current investors as to how, for their thoughts on the last, 18 to 24 months. Sums up part 1. Happy to take any questions.
Awesome, Ben. So if anybody's got any questions, you could just raise your hand, wave, or put it in the chat. I might start things off. So when you're talking about a raise, kind of what's the combination that you would have, like of debt, equity, and grants? Like if I was raising $500,000, what would you expect to see?
There's a lot of variance. It makes sense that companies are going to pursue within reason as much, low cost capital as possible. Of course, debt, but, grants. Investors love just, we're shareholders as well, just like founders. So, we want to see access to call it, grants. So at the angel stage, ACOA, they used to match maybe less of that. Typically on the non-dilutive side, it can be up to half of the raise. It can be more. There's a lot of difference.
Perfect. I've got another question. You were talking about adding in a buffer to a raise. Is there kind of any like rules of thumbs, or how much would you add up?
Yeah, and it really varies on the stage of the company. Typically and it's all milestone-based financing, right? What are the appropriate what metrics do you track? What do you need to drive forward to de-risk either the technology, the business model, so on and so forth, that, you know, if you hit said number of users or said study result, you know, the upside for the business becomes significantly greater. So, sorry, can you repeat that question? I kind of
got how much of a buffer would I add in, like
6 months? So okay. Typically, what we see is, you know, you want to give yourself at least 18 months. I say yourself, your company, 18 months of capital in a no revenue scenario. All right. So there's many factors at play in a cash flow model. You know, your revenue certainly factors into your net burn, of course. You know, your gross burn is your total monthly spend out the door. You know, you may find your revenue fluctuates month to month. So what we want to see is that, you know, there's 20 to 25% of the runway is, you know, if you think it's going to take 18 months to worth of capital and runway to hit the milestone, give yourself an additional 6 months in case it takes longer. The other reason for that is if you do hit that milestone on the time frame that you're hoping to, it's going to take another 6 months to raise that subsequent round, and you don't want to run out of money.
So we've got like a few more minutes. There was a question in the chat about the links, whether people would get a copy of the presentation. So yes, we'll send out the presentation to everybody. And then there was a question about how much grant funding is available in Nova Scotia Business Inc. So if you go to their website, you can look at their programs. They've got a number of different programs that you can look. And Sustainable Development Technology Canada has got some good dollars there. They can actually help with large projects. And I'll also say they do have a seed fund. So if you go to the website, look for the seed fund. So we'll throw it open for more questions.
I can jump in with a question if while we're waiting. So Ben, what type, you went over several types of equity instruments. Is there one that you prefer or you find investors prefer or are more common than others?
You know, at the earlier stages, you don't want to be neck deep in paperwork. So that's why the SAFE and KISS investments are preferred, generally speaking. However, you know, they were implemented through the Canadian Venture Capital Association to replicate model documents that were, you know, used in prominent tech ecosystems. So Y Combinator in the early, you know, 2010s. And over time, we found that people tried, more and more terms were added to these documents. So they're becoming longer. We were hoping for a standardization of these documents, but KISSes and SAFEs are preferred. You know, the main thing for investors is, you know, you want access to the information or the company's information, and you want to help, right? So does a board seat make sense at the angel or pre-seed stage? Maybe not, but you know, there's certain control provisions that SAFE holders want to have, and you as a founder and your legal team can you know, can structure around where the SAFE is the instrument whereby there's whereby you can incent you know, investors to write larger checks and give certain major investor rights. So one thing we see commonly, say you're raising $500,000, you know, investors over who are individual investors contributing over 50K will get, you know, certain information rights or certain preemptive rights. So a right to make a follow-on investment equal to or maybe 2x double their initial investment. So that there's ways, you know, you as the founder, you know, you want to, when you're raising capital, you really want to make your job efficient. You want to focus on the company, and anything you can do to essentially incent the right investors to write larger checks and to do it quicker, will play in your interest.
Thanks, Ben. One more just quick question, just because it does come up quite frequently, is how do investors view bridge rounds?
Yeah, so the bridge round it's not always the case, but the perception from the outside is that not enough capital was raised at the last round, and that it wasn't, because of it, the milestone was either missed. So there's got to be an explanation for that bridge round. So the moral here is don't focus on dilution. Make sure you raise enough capital and then some. That should be your aim, so that you avoid having to raise, call it this bridge round, where it can take a lot of your time and go back and forth with investors to get additional capital to drive that same milestone.
Thanks, Ben.
Perfect. So Ben, I'll get you to stop sharing your screen. So we're actually going to go on to part 2 of the session. So I'm pleased to introduce Sarah Coburn, who is a strategic communications, facilitation, and engagement expert. So Sarah has worked with a lot of startups in her ecosystem. She helps them polish their pitches, helps them focus their narrative, and improve their marketing. So she's going to provide some tips as you're working on financing. So welcome, Sarah. The floor is yours.
Thanks so much, Shelley, as I just find my way to unmuting and resharing. Great. Thanks so much for the introduction, and nice to see some familiar faces in the gallery today, and also to say hello to some new ones. That was a mouthful. Shelley's introduction was very kind, but I think at its core, I'm sort of helping to feed back what I hear from the companies, which is that you've got a ton of great stories to tell. And so today is about helping you to think about how you tell that story to market your startup. So a few of the kind of high level themes we're going to talk about today is why marketing yourself and your startup is such an important part of developing your funding path, a few of the channels that you want to be thinking about at this stage in the company, pitches and the importance of it. And I hear this in last week's theme. Ben mentioned it, and I know that Andrew's going to speak about it next week, but it's really a key part of developing momentum and awareness for your company. So we'll touch on that. We're going to talk about the media or the channels that you want to be thinking about, and how to celebrate and convert your successes. And then finally, we'll finish off with some FOMO. So, why marketing is important. It's really more than these 4 things, but this is what we're going to focus in on today. It's about creating awareness. There's a definite link between what Ben talked about in terms of that funding pathway and how do you get people on that pathway. So if you looked at that sort of chart about the idea stage or the idea funding to Series A, in the Series A, you're probably building a marketing plan, but marketing actually happens so much earlier than that. And so if you think about a snowball, it's all of these little flurries now that roll up into something much larger. So how do we build that awareness in each of those flakes? Then there's a talent attraction piece about why marketing is important. It's a super competitive landscape to find the right talent. And so marketing your company is an important piece of that talent attraction and retention as well. Partnerships, those are pilot partners and other relationships with members of the ecosystem and academic partners. And then there's this key piece that we're here to talk about today on the investment side. So, what is marketing? I'm going to invite you to drop some comments into the chat, and then maybe Shelley, I'll just ask you to call them out since I can't quite see the chat right now. But when I say marketing, everybody just pop in a word or something that comes to mind.
All right, so I'll read them as I see them here. Selling, target market, storytelling, brands and value, business development, awareness, outreach, the 4 Ps.
Mm-hmm. Yeah, great. It's all of that. And it's a million more things. It's become a bit of a catch-all phrase, right? And so what do we really even mean when we say marketing anymore? It is everything that you said, and it's a lot. And I always like to start off by saying, like, marketing is important, but we shouldn't be doing it for the sake of it, right? It really holds a lot of purpose and promise. And so when you think about marketing, we want to really sort of drill down into what we're talking about and why we need it. So there's sort of 4 main areas that we're going to talk about today. But first, what I hear when I say to people, why do you feel like you're struggling with marketing right now? They say things like this. It's not as important as other things I need to do. I just don't have the time. I'm not good at it. I don't know how. There's no budget. And so does any of that feel familiar to anybody on this call? I see some people laughing. I see some nodding heads. So I'll say yes. So what I'm going to do today tries to help make that a little bit easier for you. So marketing is, as you mentioned in the chat, it's analysis, it's emails, it's video content, it's target audiences, it's target markets, it's technology, it's strategy, it's promotion, it's network, and it's a lot more. And I think, you know, it might be fair to say that everyone's doing it in some form, but we're probably all not doing enough of it, or maybe being as focused as we could be. Because marketing is really about reaching your audiences. And so if that's identifying investors, if that's identifying accelerators, that you eventually want to be a part of, the sort of key thing to start with is, how do I reach your audience and who are they? And then once you've got that figured out, it's about your story and what's that story. And so we think about narrative, we think about the question that Ben asked, like, what is the big problem that you're solving? And so that's all part of it. And we can't really do any marketing until we have a clear idea of the audience and the story. And then bridging into channels, and I'm going to bring us all back together in a second, but we talked about audience for a second, we talked about the story, and then you've got channels. And so marketing almost has a vocabulary of its own. You may or may not have heard the word channels before, but basically that's the place that you put your story so that your audiences can find it. And these are the 4 channels we're going to talk about today. The image on the left represents pitching. Then we've got social media, website, and networking. So I'll just bridge into that one if it will transition for me. Oh. Okay, so the who and the what. We talked about audiences and the channels and the messages. I have audiences here as a larger something because they really are the most important thing to think about. You can't make messages or determine the channels until you know those audiences. So the 2 lower ones really do flow from this first piece. So website, first of all. How do you make a website? You know, thinking back to some of those objections, I don't know how, and there's no budget for it, or I wouldn't know where to start, or I'm not sure what it should look like. There's lots of people who have been through that can help. I mean, if you talk to other founders and companies, there's easy ways to stand up a website. There's lots of platforms that are really economical and easy to use. The CMS in the back end for the development of the content can be really easy to get to know. And I'm not at all technologically savvy, but I've stood up websites as well. So I know it can be done. Squarespace is one that is really common for startups. And so there are lots of other platforms and templates that you can use. And so I think the first thing to know about a website is it's possible, it can be economical, and it can be easy to start up. The second thing to know is that you want it to be professional, but you want it to deliver your story, but you need to do it in a clear, concise way. So what's beneficial about some of those templates online is that they force you to sort of drill down your content and make sure that it's easy for the viewer or the user to read. And so there's lots to say, there's lots we can put on a website, but really what we just want to focus on are the 5 whys. Tell who you are and what you're about. Focus in on articulating your company's values, the problem that you're solving, the product or service that you offer, and how to get a hold of you. So the next channel that we'll talk about is social media. So there's a million different platforms. It's really hard to keep up, even for somebody who spends a lot of time in it. And so I guess the kind of key thing I would offer is you don't need to be everywhere. In fact, you shouldn't be, because the capacity to stay up to date with all of the social media platforms can be quite a large lift if you try to be in too many places. So how do you choose? Well, you go back to that sort of first piece, who's my audience? And then you want to choose the platforms to be on based on where your audience is. Investors are focused on LinkedIn, they're focused on Twitter. So if you had to prioritize, those were the two that I would spend the most amount of time. LinkedIn is a great way to make connections and to showcase content. And more and more, they're getting integrated as ways to share content from one platform to another. So kind of key message to think about here is choose your channels wisely, because your time is limited and you really want to make sure that you're showing up in the right place to attract the right audiences. And the other thing I'll say on social media is that, there's lots you can say. You want to try not to duplicate your messages though. So if you have something on LinkedIn, don't recreate it exactly for Twitter. Just change up the message in a different way. And the more posts you're doing on social media, you get a sense of what kind of content do people respond to. And that gives you some helpful insights into what gets shared, what questions you might come from, what connections get added to your networks. The next one is the pitches. So you have the Art of the Pitch session coming up next week. I'm going to keep this high level so as not to duplicate that. And I've worked with lots of you on pitches. So for some of you, this will be a repeat to say, your pitch is really your story. More and more often, what I find is that people think of the pitch as the deck. And those are really two different things. The deck is the PowerPoint or the Canva slide deck. It's sort of supporting actor to your pitch. But I think a helpful way to approach the pitch is like, it is something else. It's the lead actor. It's you and it's your story. And so the content in it is one thing, but what you're really doing is starting to create and convey a vision about who you are as a leader in the company, where the company is headed, and what you can bring to the world. So I like for people to start off sort of with that high level intention, and then you can build your deck and all of the supporting characters, the visuals, and the content underneath of that. So what you absolutely must have as part of the pitch is a really clear message, and you want it to be aligned with what people are going to see if they visit your website after they've heard a pitch, or if they check out your LinkedIn profile. Creating that sort of consistency across platforms is really important. And again, in the example of LinkedIn and Twitter, we don't necessarily need them to be exactly the same content. We probably don't want them to be, but we want them to feel like they're part of the same family of information and that they support and build on one another. The other thing to think about in your pitch is like, what is the real clear purpose? And that's not just about your company, but it's like, why am I telling this audience these things? And so I also counsel that you really don't want to have just one kind of deck. You've got one overarching story, but you're going to pull from that every time you do a pitch. And so depending on your audience, you want to adapt that and make sure that you customize it every time. And then the last thing I think is important to say is that you want to be clear and organized, because there's a lot of content you can put in, but you don't necessarily want to try to cover everything off in one pitch. The real purpose of a pitch is to get an opportunity to kind of have a next conversation or to generate momentum and interest. And then there's networking. This is the fourth channel I put in, and it's interesting because the not very many people that I speak to think of networking as marketing, but it's so important because it creates word of mouth. It's reputation building. It builds credibility because you get to interact and engage people in a familiar way. It's also knowledge gathering, which might be the most important part of it that I think that ties specifically to what we're talking about today. Because in those networking opportunities, you get a chance to say something like, who else should I be talking to? What accelerators have you been a part of? What investors have you heard from or heard of that are interested in this area of work? And so the insights and knowledge gathering and connections that you can make through networking are really important. They're also a super way for you to test your story. So getting feedback on, every time you network or meet with someone and you tell your story, you get a sense of what have I left out? What's working really well? What's resonating with people? and you're drawing insights from the kind of questions that people are asking. Next up is content. So this is another one of those marketing vocabulary words, which is basically, it's the material that you put on the channels that we talked about. And it's either visual or written, and both are important. So what you want to think about is that your visual and your written content are, again, all part of that same family. They're very consistent and supportive of one another, but not necessarily duplicating each other. And so you may be asking yourself, how can I know that I'm being successful or I'm doing a good job at this sort of marketing that we're talking about today? These 4 things will help you stay on track. So consistency, we talked about that a little bit already. Do the messages that you find on all of your platforms support one another? Do they convey the same kind of vision to those outside audiences? Timing. Timing and frequency are a little bit like the 3 bears. You know, you don't want to be too frequent. You don't want to be too infrequent. You want to have the right timing. You're always trying to find that space where if you're too often, it starts to feel noisy. And if you're too infrequent, then, you know, there starts to be this, well, whatever happened to, or you're not staying in front of the audiences you want to reach. And then the last one is authenticity. And so when Ben talked about, you know, building your personal brand, it's sometimes so challenging to think about how you disconnect yourselves from your work because you've started these companies and you're attached to it. And so the personal brand, I think, really naturally shines through if you think about marketing and communications being authentic. You want them to sound like your own voice. You want them to just be the way you would be if you were in person, but then you'd end up showing up on another channel. And then, so just a smidge more on each of these. Look, just can't see all of the faces. So if you're writing these down, the consistency question is about the message. The timing is about the milestone that you're in. So I was speaking to someone last week saying, if you start marketing too soon with one specific message, you'll have to repeat that message 7 or 8 times because your audiences aren't so close to your milestones or your go-to-market strategy that they'll understand the importance of it. So you want to just sort of look across your path and say to yourself, where are the places where I want to show up? And so you just align those with your go-to-market strategy and your milestones and roadmap with a marketing lens as well. And that's super easy to do because I've seen that most of you have those kind of roadmaps already mapped out. The frequency, that's the 3 bears. You don't want to be duplicating messages. Saying it multiple times doesn't hit it home any harder. But you want to be thinking about creating enough touch points with different types of content that you're staying present and relevant in the conversations on those platforms. And authenticity we talked about. I won't go into any more about that. So the creating the FOMO thing, it's really, I pulled this image to say, it's really you're trying to be a magnet. You're trying to attract people to you. And that is the talent and the investors and the pilot partners and all of the other people that are going to help the company over time be successful. And, you know, I hear from companies all the time that they spend so much time going out looking. And so just wanted to reinforce in this last piece that marketing can really help to attract to you. So while it sometimes feels like effort or a lift to get into it and make it a constant part of the work that you're doing, it pays off in spades because it really does sort of, there becomes a shift at a certain part of your company where it's no longer going to feel like you're chasing all the time, and people are going to start coming to you, and you're going to leverage those networks and the success of your pitches and create all of these little attraction points. So a really helpful, hopefully tactical something, where to from here? What should you each do? I whipped through all of that in a speedy way, but happy to send these after. This is basically what you consider a little bit of a roadmap. If you've already got marketing in place and you're like, Sarah, I'm doing all of those things. Terrific. That's terrific. Then this is maybe a helpful something that you pull out once a year and you say, how has my story changed? Who are my audiences now, and how are they different from the last time I looked at my story? Because they do change over time as you grow. What content do I need? Are those same messages still working for me? Do I have the right visuals? Am I showing up consistently? And then your channels. So right now we're talking about website, pitches, social media, and networking. But every year those are going to change. There might be a website refresh with a set of messages. Your pitch is likely going to change when you're going from sort of demo day pitches or introductions in the ecosystem to investment. Social media need to continuously be at that, pardon me, and the networking ongoing. But you're going to pull out each of those bubbles and replace them with different channels as you grow. And then from here, I'm happy to take your questions.
Thanks, Sarah. I might start.
Sure.
So one of the reasons we wanted to kind of include this marketing is kind of at InnovaCorp, when we first started due diligence, we go online to kind of learn about the company, the website and stuff. So does a website have to be a full-blown effort, like pages and pages, or could a landing page be just as good starting off?
Yeah, a landing page is great because it's about credibility, right? People want to be able to find you, and when they get jazzed by a pitch, and then they want that next touch point, so they go looking for more. And so you want to just be able to feed that. And so I would say, yeah, a website definitely doesn't need to be pages and pages. It can be a simple landing page with just a little bit more information. And why that's also important, even if it is only one page, is your ability to track and analyze who's coming to the site. So for example, after you've done a pitch and there's 40 or 50 people on screen, you should be able to look and see if your website's getting some traction. It gives you a sense of how many people then went to your site to check you out. Same thing if you do a LinkedIn post that has a link to your website on it. That tracking and understanding how much traffic you're getting is super important. And that's an easy thing to do as well. When you build one of those sort of template sites like Squarespace or Craft or others, embedding Google Analytics in those is free and easy. So yeah, I hope that answers your question, Shelley. Yeah.
I'll jump in with a question.
Sure.
Thanks, Sarah. That was fantastic. I'm wondering what your advice would be to anyone who, has a social media account, but maybe doesn't quite have time at the moment to keep it updated. Because one thing about social media is you can see when the last update was.
Yeah.
I'm wondering, if they just can't quite do it yet and they have plans to kind of, be on it more in the future, are they better off having the account or not having the account?
Yeah, great question. So a few things on that. The first is thinking about which accounts you have is exactly tied to those audiences, right? So you probably don't need to be on all of them if your audiences aren't looking there, right? So you're probably not using Facebook primarily for your business. And so, what sometimes happens is that people think they have to have a place everywhere. You definitely don't. So I would say pick the ones that you feel like you can keep with consistently. And on that consistency frequency balance, if you think about the last time you were on Twitter, let's say you visit Twitter once a week and you kind of have a pattern around that, right? Then that's probably as realistically frequent you can be. So maybe you post once every 2 weeks. That's totally fine. You don't need to have a post every day or even every week to stay active. And I would say as well, if you're not sure where to start, there's some folks on this call that we've been working on. It actually doesn't take that time. Once you get started on it, you'll get more comfortable doing it and you'll see how easy it is. So the next time you're on LinkedIn and you're checking out messages or you're liking someone's post or you're looking for a bit of information on a potential customer, you can just drop in a message and it doesn't take more than 2 or 3 minutes.
Thanks, Sarah.
Feel free to unmute yourself, folks, if you want, as opposed to the chat.
Yes, Sarah, Drew McDonald here.
Drew?
Can you talk a little bit more about Fumo or they're missing out? In fact, I'm kind of thinking about elements of exclusivity and short-term opportunities or whatever that you wouldn't want to miss out.
Yeah, so FOMO is really about, like I said, it's about attracting audiences, right? So you do so much upfront work to establish the technology and then to kind of start to hit some of those milestones and you've got some momentum going. And then usually people think about marketing almost like it's not too late, but it would have been so much easier if you'd done it so much sooner. So the longer you wait to start doing it, then the more investment you have to put in, both in time and resources and generally money, to making it happen a little later on. And so the fear of missing out is that by the time you're ready to raise a round, for example, you want an audience embedded that's already notionally aware of the company, that's kind of been following your progress and your path. And also on that talent piece, I think that's really key to go back to. It isn't always just the funding. Some companies are fine on the funding side. They're not looking for investment, but they may hit up against a barrier of accessing talent. And so if you don't get out there and market yourself and the impact that you're having with your business, it will be harder and harder for you to find talent when you need it. Does that answer your question, Drew?
Yeah, it's an area that just interested in because it's pretty important.
Yeah.
Go ahead, Maya, and then we'll go with EKD after the long name.
Hi, Maya.
Yes, hi. I was wondering about the role of press releases in all of this, and if you have any resources on how we go about both making them and getting them picked up, because we've been trying a little bit, but we're really not very good at that. So I wonder if you have any input on that.
Yeah, I really think it depends on your company and what the information's about. So it gets harder and harder. It's very competitive in the media landscape to get people to pick up content. So I think it really just depends on the nature of the release. Feel free to send me a question after and give me a specific example, and I'll happily respond with some thoughts. But press releases are an important something. But they aren't necessarily the most effective way to reach your audience. So again, back to those sort of audiences and what they need to know. If they're not looking at the media channels where you're trying to land with the release, then the value of all of that media relations to sort of pitch the release can be taking a lot of time, and the uptake is not guaranteed. So I would think, LinkedIn also gives you a better way, and most releases can be shared on that platform. And then you control the sort of output, and you can also ask those in your network to help share it. So I see more companies having success with that, honestly, than a straight media relations play, but it does really depend on the content of the release. And so happy to take that offline and help.
Thank you.
Yeah.
So we'll go, I wasn't sure the name, EKDOY, the long listing. You have your hand up. We'll go to Sean. You had a question that you had put in the chat. Do you want to talk about it?
Sure. Do you have suggestions when pitching to people whose first language isn't the same as your first language, or when there's a clear language barrier?
Yeah, it's a great question, Sean. Yes, I do. And I think one way at that is through the use of visuals, because we do tend to rely a lot on copy or content, the written sort of elements of the pitch deck. And visuals can be super impactful, and they often create a sort of even understanding. And so sometimes when I work with companies, I ask them to make an entire deck of only visuals. So 10 slides, pictures only, no words. And then the effort there is for me to say, I think you're trying to tell me about the following some things. And so if you aren't currently relying on a lot of visuals, maybe think about what the architecture of your story can be, so that somebody just looking at that would form at least enough of an impression that, again, you get that opportunity to get into a second conversation outside of a pitch environment, which, can not always be a very two-way dialogue. Does that help?
Yeah, super, thank you.
Yeah.
Fidel.
Yeah, my apologies. I don't know how I was assigned that long name. I just noticed. Yeah, so my question is about the social media manager. It's something like I heard there are like some softwares and applications where you kind of manage all your social media platforms and you kind of like write whatever you want to be posted, and these applications does the work for you, and you can set up how frequent you want them to be. So my question is, what's your thoughts about such applications? Are they good to use, or it's better if you have it like personal? Thank you.
Yeah, there's a bit of background noise, so I'm not sure I caught it all, but if I hear you correctly, I think you're asking about the value of having an external social media manager to manage your content.
Right, how effective that is, and what some of the applications that you would recommend for such purpose.
Right, so I think it really depends on the sort of status of your company, what phase you're at, and also about what industry you're targeting, and also about, again, back to your audiences. So social media managers can be terrific at developing interesting content and knowing what works and performs best on social, but they may not understand all of your audiences, right? So it's really hard to bring in somebody who, for example, doesn't understand the investment landscape and ask them to create a content calendar with all of the social media posts that are going to appeal to venture capital investors. So I think it has a place for sure, but it really does depend on the stage of the company and also the industry and also the audience that you're trying to focus on within that, let's say, that milestone period or a set of quarters. Once the company is established and you're actually in market with a product, having a social media manager to make sure that there's constant content development can be super beneficial. And that really relies on, once you've got an established product and you've got an established voice for the company, it doesn't necessarily have to fall to you. So I think that there's a bit of a transition that starts to happen as you grow. Any other questions?
I don't think.
Okay.
Okay, so Sarah, thank you so much. Great words of wisdom for all the companies. And thank you, Ben, too. I'm going to pass it over to Jennifer to kind of talk about kind of the upcoming sessions and a special opportunity that we're going to provide.
Thanks, Shelley. So as many of you may have noticed in our marketing for this series, we're offering a special opportunity for select companies to win free coaching sessions with Sarah. So this coaching will focus on some of the topics covered today: developing your story, marketing yourself and your company, and refining your pitch. You'll have the opportunity to apply for this free coaching at the end of the series. So after the final session in a couple of weeks, we'll send out an email with details and instructions on how to apply. And criteria we will assess will include things like your current or prospective Nova Scotia footprint, stage of your company, market potential, technology readiness, and so forth. So stay tuned. It's a great opportunity, and we would love to see you apply to take part. Perfect. And yeah, and I'd just like to also say thank you again to Ben and Sarah and to everyone for attending today.
Perfect. And I will mention that there will be upwards of probably 4 or 5 coaching sessions that will be provided for kind of this audience. Thanks again, Sarah. Thanks, Ben. Slides will be sent out to everybody, and we will see you next Wednesday.
Have a great day.
Have a great
Thanks,
day.
Everyone.